Good morning. Thank you. Thank you for having me. It's great to be with you, and so much to talk about, as was mentioned, on a pretty hectic and chaotic week in the markets, but I think there's lots to talk about. We're going to be talking about herd immunity, if you will. The herd is something we never want to be part of. So we're going to talk about how to not be part of the herd and how to make money in the process doing it. Now, why me? Why even listen to me? Well, I got started many years ago, as was said. I was a trader on the floor of the Chicago Board of Trade. I opened my own private fund, Capitalist Pig Hedge Fund, in 1999. And since about then, I've also been a pretty regular speaker on Fox News Channel, Business, and a lot of the other media entities as well. So you might have seen me on TV, as they said. I've been trading professionally for well over 25 years, and my returns actually beat the market, something not many active managers can say over a 20-year period. I actually bested the market, even with my 2 and 20 fees. So why should you listen to me? Well, because it's all about making money. It's all about bucks, kid. And there's many different strategies. There's many different approaches. You're going to hear a lot of them today. And I've got one that I think is important and one that I think that should stick. It starts with the S&P 500 index. I mean, there's a sense about the S&P 500 that it is almost holy. You know, this is something that is like godlike, if you will. The irony is that it was, as late as the 1970s, it was thought as, the S&P 500 is thought as being actually unpatriotic. The idea is, oh, why buy every stock? You should pick stocks. But these days, the S&P is it for most investors. The idea is, oh, I can't beat it. I can't best it. You know, why even try? Just buy the indices and hold on for the long term. This is what most investors believe and most investors are told. And it's not just because I run an active management firm. I think that is absolutely wrong. That is incorrect. And I'm not kind of picking out numbers or making believe that that's true. Just take a look at the market this year. Just this year, the US is dramatically outperforming world markets. VEU is an interesting ETF. It's worth looking up. VEU is basically global stocks ex the United States. And you can see there pretty clearly that, you know, over the recent months, over recent weeks, the S&P 500 is dramatically underperforming global stocks writ large. And it's a big, wide world out there that over the last 8 or 10 years, I think many investors have forgotten about. So if you want to not be part of the herd, one way to start is by looking at foreign markets, looking at foreign economies. So don't be xenophobic. Don't be xenophobic in real life or in your portfolio. Look at some of these ticker symbols and you'll see that the real action so far this year, and I do believe that trends tend to persist, the real action has been in global stocks. It hasn't been in the US. Here's just a few examples. Poland. Who would have thought? Poland, EPOL, up, some 34% year to date, far outpacing the S&P 500. Italy, same thing, up 20+% just year to date, far outpacing what's going on in the US. Europe, the irony of everyone saying, well, Germany is in a recession, meanwhile, German stocks hitting 52-week highs. This is why I'm a technician, why I think you should follow trends and follow price. That's where the real story is. Here's Spain, also up some 25%. Norway, deep value in Norway. This is an ETF that yields well over 5%. It's up 15% just so far year to date. And more than anything, no herd. I mean, do you see anyone on Fox Business pounding the table on Norwegian stocks? I mean, this is just something that is such a minuscule part of anyone's portfolio. Now, I'm a technician, as I said. I look for trends. I believe that trends tend to persist. But if you are a fundamentalist, if you look at price-earning ratios, you'll also see that these stocks are incredibly cheap relative to US. The S&P 500, even now, has a PE of over 25, trading at nearly 5 times book, and the non-US ETF is half that. So non-US stocks are technically stronger and fundamentally cheaper, and without the herd. And for me, that's probably the most important thing. I mean, if the table was being pounded now on international stocks, if they were being recommended across the board, I'd say, well, maybe you did miss the boat. But I think, in fact, because markets tend to trend, the trend actually hasn't really even started. Here's a fascinating graph from Wisdom Tree. And you'll see the purple areas are areas in which foreign stocks outperformed. The gray areas are areas in which U.S. stocks outperformed. So we've had this long-term outperformance of U.S. stocks, but I do think the tide is turning for that. So for further evaluation, you want to avoid the herd, these are some things I think you should put on your list for further evaluation. One, without question, is non-U.S. stocks. Technically stronger, fundamentally cheaper, and no herd, unlike the U.S. There was an old saying on the trading floor that I used to like. You want to be long doubt and short hope. What does that mean? Well, most people, when they're doubtful of an investment, they say, oh, Bitcoin, what could that possibly do? Meanwhile, that was 2013. So when people are doubtful of an investment, that's usually a good time to be bullish. When they're hopeful for an investment, that's actually usually a good time to be bearish because they've already purchased it. Gee, I hope Netflix rebounds. I hope Bitcoin rebounds. So you want to be long doubt, short hope. So non-U.S. stocks, I think, a great place to be investigating, not despite this week's tumult, because of this week's tumult. In fact, I'll just quickly mention, you saw the largest drop in the value of the dollar on a one-day basis ever over the last week. That benefits not only non-U.S. stocks, but the other asset class I hope you consider, and that is commodities. It's a big asset class. There's lots of different kind of commodities, obviously. The one that has been probably most talked about for good reason has been gold. Gold breaching $3,000 an ounce just in the last couple of weeks. Here's the 3-year chart. And, I look at this and I think, how many times was gold at an all-time high? Over and over and over and over again. And that's the point I'm trying to make in terms of trend. When a stock is making new highs, it's like on the right-hand side, it's like a green light. It's like the market's telling you, green light, go. When a stock or an asset is making new lows, that's like a red light. That's like the market saying, stop. You're on the wrong track, in effect. Most people interpret the market, though, in just the opposite way. We think about it. Most people, if they buy a stock at 100, it goes to 110. Most people's instinct is to say, get me out, get me out. I made my $10. Conversely, they buy a stock at 100, it goes to 90, and most people think, oh, if I liked it 100, I should love it at 90. When a market's moving against you, when assets are at multi-week, multi-month lows, that's a bearish signal. And we're seeing just the opposite, by and large, from commodities. What we often think of as being the high is usually not the high. It is just a high. There'll be another one tomorrow, and gold is probably the best example of that. You want to buy assets on a scale up. This is very difficult for people to get their heads around, the idea that if you like XYZ, you want to buy it at 100, 105, 110, 130, 150, because you think it's going to 200. Most people are much more comfortable buying on a scale down. They say, oh, if I buy it at 100, I'll buy more at 95, more at 90, more at 80. That's actually a losing proposition because the market itself is telling you you're on the wrong track. So you want to buy on a scale up, not down. And like most things, people go all or nothing when it comes to investing. I think that's where they often we hang ourselves, we slit our own throats. So consider commodities as one part of a portfolio. Not the only part, but certainly one part of a portfolio. And I think now more than ever, the market's giving us objective reason to see why that's the case. I've showed you some examples of commodities being technically strong. Gold is one example. But I'll give you one that I actually am investing in right now. You always want to do your own due diligence, but I'm looking quite strongly, and I'm already invested in platinum for a lot of my clients. The ticker symbol for the ETF that tracks platinum is PPLT. And as you can see, it's a pretty ugly chart over the last 10 years. But as the old saying goes, a rising tide lifts all boats. And I do think that as gold breaks out, as silver breaks out, as now commodities writ large start to rally, you'll see platinum not just retake the yearly high, but in fact, the 10, 15-year high. I mean, platinum is about half the price it was 15 years ago. half the 2011 price. Pretty amazing, considering the scarcity of platinum. You might have heard the oft-quoted adage that if you took all the platinum ever mined in the world, it would fill up just about to your ankles in an Olympic-sized swimming pool. There's not a platinum out there. Not a lot of platinum out there. It's actually 30 times more rare than gold. So PPLT is one. Always do your own due diligence, but I think put it on your list and do some investigation. And at the very least, you want something in the commodity field. They are technically stronger than stocks, and once again, cheaper relative to stocks. I'm not a fundamentalist, but here's a graph showing the comparison ratio of stocks to commodities. And you can see that even given the recent strength in gold and a couple of other precious metals, commodities are at a historically cheap valuation relative to stocks. So find an exposure, I think. If not now, when? Find some exposure for commodities, if only just a commodities index fund. You know, the old adage, keep it simple, Sam, KISS. Well, you know, if it's just DBC, which is an ETF that tracks a broad basket of commodities, I think for either your clients or my clients or for our own portfolios, now is the time that makes sense. The thing I don't like about DBC, I'll say, I mean, it's liquid, it's, you know, widely tracked, it's relatively low cost. It's quite heavy in energy commodities. So I think precious metals, for example, is only roughly 10%. So it's pretty overweight in energy. But you know that dog will have its day as well if the bull trend in commodities continues. One more thing I want to add to your list of ideas for further evaluation is not even so much an asset class. We've talked about stocks, we've talked about non-US stocks, we've talked about commodities, but a philosophy of absolute return. What does that mean? Well, making money. Actually making money. Oftentimes, you know, before I got into the hedge fund business, I used to marvel at investment advisors would say, well, the S&P was down 12, but we were only down 10. And I would think, well, what good is that to be down 10? Absolute return, I think, is the name of the game. If you're a newborn, if you're a 20-something, yes, you have decades to wait. I do not see any newborns in this audience, and not too many 20-year-olds. Most of our time horizons are a lot shorter than the market itself. The market has all the time in the world. The best example of that I can give is probably Cisco Systems, not the food service provider, but the telecom or the tech company. You know, 25 years ago, Cisco was almost like what NVIDIA is today. I mean, Cisco was the name that you had to own. Everyone owned it. It dominated the major indices. And the idea was, hey, if the internet's going to be the future, Cisco is the internet. Cisco is the future. And you know what? The internet was the future, and Cisco did do very well in terms of sales and earnings and everything, but the stock is still not back where it was 25 years ago, if you can believe that. I mean, the market has all the time in the world, and we do not. So you have to have that perspective of needing to compound money over and over again. Not beat the market. The idea shouldn't be, in my mind, got to try to beat the S&P 500, but to compound assets over time. Our horizons are much more limited, especially for probably many people in this audience who either are out of the workforce or who are leaving the workforce. And given markets valuations, even despite, what has it been, 3,000 or 4,000 points off the Dow, it's not hard for me at least to imagine a period in which the broad indices, still dominated by expensive large cap stocks, are flat for years. And you don't have to go too far back into history to find it. From roughly 1999 to 2012, the broad indices went nowhere. But there were so many other asset classes, like foreign stocks, like commodities during that real estate investment trust, all did well during that period of time. So the market has all the time in the world. There is a obsession with owning the S&P 500. I think now is a great time not to own the S&P 500 and to understand what matters is not beating the market, but compounding. You know, if you can compound 8%, 8-9 years in a row, that's serious money and certainly much better for a client than up 30%, down 35%, up 10%, down 12%. So it's that compounding over time, that's where the money is made. And I believe that requires just the opposite of solely investing in the S&P 500. I think it requires active management, real diversification, not simply buying the S&P and waiting. And as I said, especially considering that today's S&P 500, it's presented as a diversified index, but it's not. I mean, this has been covered ad infinitum in recent months, and it hasn't changed. It is dominated by a small handful of 10, 12 tops mega cap companies, most of which still have PEs exceeding 25x. So this is an expensive index, as I pointed out, and a weak index. So have that perspective of absolute return. I'm now not only managing a fund, but I'm actually working with individual clients. The idea is to integrate those alternatives into traditional portfolios. Many of them are available as ETFs now. And for your own portfolio, it's about making money, not beating the market, not bragging about it on social media, but beating the market and more than anything, being able to sleep at night. So you're taking those important steps. You are becoming a better investor today simply by being at the Money Show. I applaud you for doing that, and I encourage you to check out what I'm doing as well. My book is called Price is Primary. It's available at Amazon. There's my phone number, email, and etc. if you want to kind of connect and learn more. So my hat's off to you for becoming better and more sophisticated, better educated investors. Have a great show, and thank you for having me. Sure. Questions? I'll do my best to address any questions that there might be.
It's a good read.
It's a good read. Thank you. I agree with that. It is a good read. Well, the theme of the book is, the trend is your friend. And I'll just say Friday saw 1,000 new lows and I believe only about 10 or 15 new highs. A majority of stocks are trading below their 50 and 200-day moving averages. So we're not in a bull market now. Doesn't mean we won't be. Doesn't mean the next 6 months won't be terribly different. But I see a lot of falling knives from my perspective, especially when it comes to U.S. stocks.
Hi. So you mentioned gold, precious metals, physical or ETF? And do you own physical? Do you have it? Keep it in the bank? What do you do?
Sure. Well, there's a real risk in physical ownership of metals. Just the fact is you've got to store them somewhere. Now, you can have a safe deposit box. It has less risk, although there still is risk with that. My experience, the people who want to own, and this is not advice of any sort, but my experience, the people who want to own physical gold want to own it to make it kind of disappear from the government. I don't know whether that's a good strategy or not, but I think for me, I prefer the ETFs, GLD, SLV for silver, and then as I said, the two so-called white metals that I'm quite bullish on, PPLT for platinum and PALL is the ticker symbol for palladium. These are well off where they were just a few years ago. So I'm bullish on the metals, and I think the white metals in particular, PPLT, PALL, and I do not advocate keeping a lot of precious metals or things of value at your home. I think it's just too susceptible to fire, loss, or theft.
You made me some very good money on Permian Basin Royalty Trust. So how do you know when to leave?
When to get out.
When to get out.
When to sell is the hardest. When to buy is easy. I mean, buying is easy. It's when to sell that's very difficult. And thank you for that kind of comment. That's one that was mentioned years ago on Fox, back when that was still a pretty novel idea, the energy trusts. For me, selling, it's all about you, your own position. The position you want to be in is that you bought it at 50, you added it 55, 60, 65, 70, and 2-3 years later, now it's at 150. And one reason to sell is because a stock has grown to become a huge part of your position. We all want to have that problem, and it happens all the time. The way to do it is not, however, in my opinion, to just indiscriminately wake up one morning and say, get me out. But you use, and I talk about this in my book pretty extensively, you use what's called sell stop orders. So the market's at 100 and you say, I've got 1,000 shares, sell 200 at 98, 200 at 96, 200 at 94, 200 at 90. So if the market reacts corrects that 10%, I know I'm getting out. So try to take your cue from the market, because we've all probably had that experience where we think, oh, well, I should sell this stock, and we sell it, and 2 days later, it's up another 10, 15, 20%. So as long as the market is moving in your direction, you want to really try to stick with that trend. One reason to sell, if it grows too big, The other reason to sell is if the trend changes. And to me, the best indication that the trend in US technology stocks has changed was a 52-week low for Microsoft last week. I mean, Microsoft at a 52-week low. I mean, this, to me, that is like the bell tolling for the reality that US tech stocks simply are not the place to be right now. Thank you all very much once again.